Hey guys, welcome back to another episode. Today we got a special guest in the studio, Christian Heaviland. He's out of San Diego. He's joining us to talk about landscaping, talk about growth, innovation, and we're going to talk a little bit about the future. So Christian, welcome to the show today.
Thanks, Justin. Glad to be here.
I'm excited to have you, man. Christian and I we've been talking for like, I think we got introduced by your dad, actually, Tom. Tom Heaviland runs Verde Property Services, and we were at a conference. He's all, dude, you gotta talk to my son Christian, and you guys are gonna hit it off. And we have. We've been rapping about the landscape industry and what's going on. So, Christian, I'd love to start a little bit about your background, just where you started. I know you started in the landscape industry and kind of how that went, the exit you guys had. Would love to give the guests a little background on that. Would you mind just kicking it off?
Yeah, absolutely. So, probably like you, Justin, grew up digging ditches, driving Toyota stake bed stick trucks, and I just born and raised in the industry. I started in the field and worked my way around. My dad told me, I don't know if you want to go into this industry. It's a tough industry, and he kind of actually pushed me to go somewhere else, to go into real estate or insurance or something, what he considered a little easier than the landscape space. And anyhow, after college, joined the company and really worked my way around. Again, started in the field and became an account manager, worked in sales, and eventually joined the executive team. Let's see. I'm trying to think of all the things that I did, but
it's so much, man.
Yeah, really became kind of a Swiss Army knife in the company, and worked on a lot of special projects, and on the executive team, and then eventually helped my dad grow it and sell it. And so we sold to BrightView, and it was a great exit, a great opportunity. My goal was never to take over my dad's company. I really had this focus of getting my parents and my dad to a place where, if we had the opportunity to exit, let's do it. I was always entrepreneurial and knew that like my journey would take care of itself. And so, when that time came, we started exploring a little bit, and when we were first talking to BrightView, we weren't sure if we were going to sell or not. And eventually they came in, and they really impressed us. We were talking to a couple other groups, and and then the numbers started to show up, and we were like, okay, this is a great opportunity for my dad to exit, and for me to kind of start my own journey. So it was a special time, but also a time where, all of that hard work, my grandfather and father started, actually they bought this company. It was one truck at the time. And, all of that kind of coming to a close was a really surreal moment, an emotional moment. And we wish my grandfather was there to experience that. But it was, it set us in motion into this next chapter, and we can get into all of that as well, but I'll stop there.
Yeah, well, that's incredible. And I think the foresight you had to, at that age, think about your parents, think about the entrepreneurial journey rather than the legacy family company journey, which kind of interesting enough, it's unusual, I would say. Like, it's not in the norm for that process to play out. And most of the time I see founders, or even like where your dad was, they hold on hoping their kid will take over, hoping their son or daughter will take over, even if the son doesn't want to take over. And then you guys are all left with kind of this weird situation because it's not built to sell.
Yeah.
But you guys are in the San Diego market, right?
Yep.
And I think when we think of BrightView today, we think of, maybe subpar landscaping in certain markets. But I do think in 2019, when you guys exited, there's certain markets where BrightView really did a good job. And I do think like the Southern California region is an example, the Phoenix region, South Florida region. There's a few other regions in the Northeast where BrightView, I think, and why is like, well, Valley Crest, right? Whereas the Valley Crest founders, they're in that Southern California region, whereas the Brickman founders are in the Northeast region. And so I think that's an interesting take. And I'd ask you, when you guys did sell, what was that process like? What were maybe the 2 or 3 key things you did? And I'm thinking about the listeners who are wanting to maybe sell at some point right now, that helped you guys get a better valuation, that helped you guys get a better exit?
Yeah. The first thing that comes to mind is we had an incredible M&A attorney, Patrick Monroe. He was really in our corner from the start and was a guide for us the entire time. I've used Patrick since then and really respect his work. And he was a key, probably the most important person in our corner at that time. I think the other side to it, we didn't use an investment bank. I feel like we got an incredible deal and didn't have to pay those investment banking fees. And one of the reasons was that we had a large network in the landscape space, and we used peers to understand where the market was in terms of valuation. And so, I think, understanding, kind of talking to other folks who have done deals in the space, that know the space. And for us, we felt really comfortable between, that network that we were relying on, as well as Patrick. Those were kind of the 2 key pieces of that deal for us.
Yeah, I've heard that before too, is having a really good legal counsel representing you, because let's face it, when you're negotiating with a company like BrightView, or name the other top 10 companies in our industry today, this is what they do professionally. They buy companies, and their M&A attorneys and their contracts are set up in their favor, as they should be, as I would set it up if I was them. So for someone selling, it sounds like having a good legal counsel on your team from the very beginning can probably help avoid some pitfalls and some potholes of taking away from value, taking away from exit value at the end of the day.
Absolutely. Yeah, you want to have an expert team. I mean, I'll just touch on one other area. Your CPA, having a strong CPA that can help through, the accounting piece. And there's some technical accounting equations that are part of the M&A deal, more so on the buyer side. But as a seller, you want to understand how the buyer is calculating certain things like net working capital. And so, you want to have a strong M&A team when you're looking at going to market and selling your company.
Yeah, and I think net working capital is such a great example of something that catches most sellers off guard at the end, because it's kind of, I've noticed it, and I've talked to a few sellers who said, hey, at the 11th hour, we got hit with this, NWC thing, this net working capital, and we had no idea. We didn't expect it. And then the buyer was just like, well, I obviously need some money in the bank and some money in the business to keep it going. So for guys listening, net working capital, it's kind of a bit of a complicated thing to explain, but it's basically, I mean, I don't know, Christian, maybe we can do it together, but how I see it is, what does the business need in working capital to just run? Right? Because you can't just walk into a company and take every single dollar out of the AR, every single dollar out of the bank, and leave the AP and leave every other expense in the business. You have to have a certain amount of money just in float, if you will, especially if you're a construction company. It's going to be bigger. Landscape maintenance may be a little lower, but they expect a certain amount, right? And what else? What am I missing on net working capital?
Yeah, I think that's well said. It's essentially like the gasoline for the car, right? Are you going to include the gasoline with the purchase price, or are you not? Am I going to have to fill it up? So generally, gasoline is included with the vehicle, and just like a business, we're going to include net working capital. So that's going to come off the purchase price. Or if not, the buyer is going to have to bring that capital to the table. And so they're going to discount the purchase price. So I think you covered it well, but essentially it's the capital that keeps the engine working, which is the business, the day-to-day expenses.
Yeah. Yeah, and I think there's a history of that, and depending on your business, how much money you need in the bank, most of us know because we've been low on certain weeks and higher on others. It's it can be tough in certain industries and certain sectors. Like for us, sometimes we do, and we've not as much, but we've done a lot of commercial insulation in the past, and that cycle is like 60 days, 90 days till we get paid from our GCs. And that's painful. I mean, you got to spread that out over months. Whereas I think landscape maintenance, you're kind of like billing at the beginning of the month, getting paid at the end of the month. It's pretty cash flow positive for the most part. So when you guys exited, what was at that point? What's your next step from there? Tell us a little about. You went into more of an investor founder mindset, and what did you learn through that process?
Yeah. So we had a transition period when we sold. We sold at the end of 2019. November of 2019 was the close date, 1st of November. And then a transition period. I was out after about 3 months. They didn't need me, which was, we discussed. And then my dad had a longer transition period with an earnout and so forth. And for me, I started to focus on kind of what was next. I think if that's what you were asking in terms of kind of what was next for me. I really wasn't sure what was next, actually. I had no clue, right? And so this is February of 2020. No one could predict what would come after that, right, in March. But what I started doing was I started taking some finance courses online. I really enjoyed learning about the deal process, going through that sale, the sale process of our family business, really opened my eyes up. I learned a ton through that, and I was really hungry to learn more. And so I knew, on the operator side of the business, I had a lot of great experience, and but I didn't have kind of this finance side, even though I had gone back to school and done my MBA and had, certain accounting and finance courses. I didn't understand kind of really the deal side of things. And so I went back and took some financial modeling courses and really wanted to understand, call it the private equity side of things. And so, or investment side. And so that's what I did. And then, took up some consulting, actually represented another company, took them to market, and then connected with a private equity group and then started working with a few other private equity groups on some deal origination. And so I was kind of just figuring it out. I didn't have a plan other than just what I've always done was just work hard and follow my intuition and my curiosity and it's really, it's unfolded quite a bit since then. But, it was just about what excites me and what do I want to learn right now? So
that is awesome.
Yeah.
Yeah. So that's got to be a weird time because you're probably working so hard leading up to that sale, doing all that work, trying to make sure the business is set up, ready to go. And then all of a sudden, 3 months after close, you're just, there's nothing, you kind of have this, you wake up on Monday morning, okay, what am I going to do today? That's probably had to be quite a, I'm sure a lot of people go through that transition of now I need to figure out, cause how long were you working with your dad at Heaviland before you guys sold?
Yeah. I mean, I was in the business for about 10 years.
Wow.
But there's school in between that. But yeah, so kind of the better side of 10 years and then so a long time.
Yeah. Half your life almost.
Yeah. Exactly.
At that point. So. Yeah. That's cool. So I want to kind of dive into a little bit of where the industry is today, where it's going. I think that's
Sure.
a big area that I want to talk about with you just because you've got such a unique perspective on the industry and you're, watching all these things happen. The last couple of years has been, at least the last 12 months, I would say, has been pretty wild. You've got new software entering the market. You've got companies like Crest doing electric batteries and robotics, autonomous mowers. You've got obviously private equity going hard into some new companies and just a lot going on. So with some of these mega trends that as Don Gao calls them from Crest, what are some of the biggest trends that you're seeing that are most, I'm going to use the word most disruptive to the industry, that are changing the way we operate and are requiring owners and operators to change to stay competitive?
Yeah.
What are some of those trends that you're seeing?
That's a great question. My mind was just like racing towards a couple of different things, and then it just kind of hit me that I think legal labor is like, this has become like a huge thing just almost overnight. It feels like. And so, we had ICE. I've told you this story. We got a letter from ICE. Not even sure if it was real or not, but we took it serious because it was jail time, hundreds of thousands of dollars in penalties, and we had to lay off a decent chunk of our workforce. This was back in 2016, and it's even a different day today. And so we could absorb that at the time. But if you've got a labor force that's got 50%, of your workers that, they showed up with I-9s and the paperwork is quote unquote good. That doesn't mean they're legal, right? And to lose a big portion of your workforce is going to hurt. And so I think, the trend, if I'm an operator today, I'm focusing on making sure that my existing workforce is secure from a educational standpoint. And they know their rights and they understand how the law works. But then I'm also looking at where is that risk inside the workforce, and if there are guys who aren't E-verified, then I'm looking to start to probably right size that and make sure that I'm fully compliant. And so I think that's a huge trend. And I know I've kind of talked about that for the last couple of minutes here, but I think, that is, without, we can have technology, right? That trend popped into my head, and the data side of things and equipment, robotics, but without labor today, that to me is the biggest trend is making sure our labor is squared away.
Yeah, I completely agree. It's kind of it's the foundation. You need it. You put it perfectly. And I think what we're seeing today, and there's a few different key indicators of this. First off, talking with a few brokers who do a lot of deals in the landscape industry, both of them told me they have 80% of their buyers, their private equity people and people they sell to, said, don't bring me any deals from California right now. Like, I just don't care. Don't want to look at a company from California because it's not an E-Verify state.
Yeah.
And they're going as far as saying, I don't want to see any companies that are not an E-Verify state.
Yep.
And what's interesting, I don't know how much this is going to change. We're recording this, mid-June. So this is, peak riots and protesting and all this stuff going on with the ICE raids that have happened over the last couple of weeks. And what we're seeing, I'm like really studying some of these cases, and part of these cases, some of them have happened in E-Verify states at E-Verify companies. And the ICE is literally like, we don't care about E-Verify because it's not a perfect system. And I've been very vocal about this in the past. Like, E-Verify is it's a good thing to have, but it's not a cure-all. And there's ways around it. There's ways to kind of like cheat the system on both sides. And so some of these places that have been raided, and I want to say they're just like showing up at raiding places. They are doing investigations and they're finding, human trafficking and other huge crimes happening, companies that are connected with cartels and what have you. And like, it looks random, but, and look, I'm not there doing this, so I can't speak to it. But from what I've seen, almost every big case that's hit the media, when you dig into it, and this is where I love like AI and stuff, because you can do such deep research so quickly. There's so much more to the story that we're not being told.
Yeah.
So as much as, you should prepare your business at any point, there is a level of investigation that is happening But at the same time, it's like we all operate on KPIs in our business, right? Like how many cold calls do we have to make? Well, unfortunately, I think the president and others have set certain KPIs in place. Like we have to hit these numbers every week. We got to hit, 3,000 deportations every week or whatever it is. And at some point, I do think the ground soldiers are going to take actions that might not be in line with the best practice to hit their KPIs.
Yeah.
And we have to understand that. So, man, I think this is such a great conversation. It's a scary conversation that a lot of people won't have, but we have to have it.
Yeah.
And so for someone who's listening to this thinking, shit, like I might have some pretty big exposure, what, in your perspective, and obviously, guys, this isn't financial advice. It's just a couple guys shooting the shit here. But like, what disclaimer.
We don't know anything.
We don't know anything. I think ChatGPT says that. Like, you got to verify these facts. But
yes.
Like, what would you recommend? What would you do if you had a business like that and you were growing fast? I mean, how do you continue to hire and build a company in a market that's challenging?
Yeah, it's a good question. I mean, San Diego is one of the toughest markets, and to right size our labor and start E-Verify, we had a 100% E-Verify labor force when we sold, and it's not easy because not everybody's competing at this within the same boundaries, and so look, it goes back to how do you do more work with less guys? How do you tighten up, and we'll get into the trade secrets or the trade secrets. But how do you really reduce your costs within your P&L so that you can pay your guys a little bit more, right? And start to compete. You got to compete on a different level. And it's really, it comes down to what you can pay your guys, right? And so I think, for us, it was, we need to get profitable, we need to be lean, and we need to be able to pay our guys more than what probably the guys, than the guys next door. And when I say next door, we were in our central branch, we had 5 landscape companies just on our, call it block or cul-de-sac. So wow. if you're not happy, I mean, just walk next door and you'll get a job. You'll get hired right then and there. And then, and so it's like, that's the kind of competition we had in San Diego. And so, but yeah, back to your question, if we're scaling, it's, you really have to lean out the P&L and be able to pay your guys more is what I see off the top of my head right now.
Yeah, I completely agree with that. It's a massive strategic advantage if you can have the highest paying jobs in the area for the same type of work that your competitors are doing.
Yeah. And
a lot of people think that, well, if I pay my guys another $2 an hour and we're at a 50% gross margin, I need to charge my clients an extra $4 an hour because, my costs went up, my prices have to go up. But I think what you're alluding to, there's some opportunity, efficiencies,
yes,
technologies, others that we have to leverage. And I think this is a conversation with your team. This isn't a CEO and the executive team saying, all right, we're going to raise wages and we'll figure it out. It's like bringing your whole company together and saying, hey guys, like we're up leveling our entire career path and everybody basically is getting a $1 raise of some sort or what have you, however you want to frame that. But here's what we need from you in return. Like we need to be more operationally efficient. We need to get out of the yard in 6 minutes instead of 8 minutes. And it sounds weird, but you have to start playing in minutes instead of hours when you get to efficiencies. And I think that's how you can win-win your labor force and pay them more, maybe 10, 20, 30% more than your competition.
Yeah, and most landscape companies are running too heavy anyhow. So if you got a few guys, you could probably trim some fats and then right and boost that revenue per full-time equivalent is what we would call it, and scale from there. But yeah, it's, labor's always a challenge, and it feels like oftentimes we're short labor, but the amount of P&Ls that I've seen that don't look good, I'm like, man, there's 3, 4, 5 guys here that shouldn't be on the P&L. Like there's just too many guys on maintenance, or there's too many guys on construction. You've got too many irrigation techs that aren't billing their hours. And so that's where I think that's like the starting point is like, are we efficient here, and can we cut some fat, right, to start, and then work from that place of, now starting every new hire that we then bring in is e-verified or, documented and so forth. So tricky, but there's usually a little fat in there that you can cut out to start with. So
yeah, and don't make the problem worse by hiring more people who aren't going to pass a audit from the authorities. I think that's a big one. I think when we talk about this stuff, I always get people messaging like, hey, what should my full-time equivalent be for a maintenance company or a construction company? And I'm like, where? They go in Dallas, Texas, or they're like in Chattanooga, Tennessee. I'm like, guys, it's so or Oklahoma or California. I'm like, it's going to vary so much. I think the best part of the disruptors community, which thank you for being a part of that. The questions that are in there and the people that ask these questions, like revenue per employee, what's really cool is because the community is closed, all of us are sharing our raw data. And so you might not have a specific number that you need to hit based on the data, but you will be able to see, oh, Brian's over here and Tiffany's here and Chase is there and Austin's here and Andrew's here and Justin's there. So with that, you start to cobble together maybe some industry benchmarking. Like if you're a maintenance company, you want to be between 110 and 150,000 per full-time equivalent in the field. And if you're in construction, maybe it's 220 to 350,000, So it's like, where are we landing with these team members, and how should we be operating? And I completely agree. And a lot of people, my recommendation is go back in your P&L if you have the ability and you have something like Aspire or something, and run that report of revenue per full-time equivalent. And I think if you're a $10 million company today, but you were a $2 million company 5 years ago, you are going to see a point where your full-time equivalent was really high. It's probably going to be between 3 and 4 million. And then as you got to 5, 6, it's dropping. Hopefully at 10, it's starting to come back up. But you're probably going to see a point where, again, 3 million-ish, you're really profitable too. And you're like, all right, FTE was the highest, profitability was the highest that year. That's your new target that you need to hit at scale now. So with us at 20 million, we're looking back and the most profitable years were 3 million, 4 million, 5 million. We're trying to get back to that FTE. We were a lean startup back then. And now I have a VP for this and a director for that and a manager for this and a crew leader for that and a supervisor here. And that really slows down our production at the end of the day because there's so many people that need to get on the same page before we can go out and actually do work.
Yeah. And for those that are listening, I mean, that's the gold that you really get in the disruptors. I mean, I really want to hit on that, Justin, like the group that you've put together in the disruptors and the members there. I mean, people are just sharing incredible information. Man, like what I'd do to have that, or that, when we were operating. I mean, a lot of times it feels like you're alone, and you're not sure where to turn or who to go to. And the disruptors is an incredible group, and what you just said there, and just the information that you're providing, and really the platform that everybody's participating in is just incredible. So anybody who's listening, join a group. And if it is a group, join disruptors. But man, shout out to you for putting together an incredible group.
Thanks, brother. Appreciate it. And thank you for being a part of it. I think it's the diversity of backgrounds that makes that group so powerful. We've got big companies, small companies, startups. I don't want to name a bunch of names because some people don't want us to share it, but some of the guys in there are just like, they just have their first crew going. And they're getting access to guys like you and me and I know Andrew Kraft doesn't mind me dropping his name. Like Andrew's running a $50 million company in Dallas, and this guy's in Austin running a 4 or 5 person company.
Yeah.
And they're collaborating. Like,
I know. It's incredible.
That's amazing. And this stuff happens at conferences. Like, as you get out and go meet with people at conferences, you have these conversations. I was just trying to figure out, how can I keep those conversations going and have access to them 24/7. So it's a pretty cool concept. There's some other guys doing it so it's like whatever fits you and your boat. Like Disruptors, obviously, we're here to change things and innovate and disrupt. And if that's like that's your goal and that's what you want to do and that fits your ethos, then like that's a place for you. There's some other brands out there that have a little different of an ethos and core values, and like find your home, find your family, and stick with it.
Yeah.
So with that, I think there's some good conversations there. Obviously, you have a lot of experience in that private equity world. You've played in that for a couple years. I want to talk about that a little bit because I do think there's a lot of people that are just genuinely curious about why today private equity is so excited and invested in the landscape industry. So is there any just high-level fundamentals about the landscape industry that you think are attracting the private equity type?
Yeah, look, I think COVID was a big indicator for private equity in terms of what industries do we want to go after. And those industries were the essential industries, landscape being one, right? So, I think a lot of private equity guys said, okay, here's all the industries that literally did not stop during COVID. These are seem to be sticky, important. Now let's start to create some filters and see which industries are best first. And I think they went after, call it the HVAC, plumbing, kind of that residential home service space, highly profitable, people paying up front, so good payment terms and so forth. But as they've, gone through that list, right, landscape is in there for a number of different reasons. But of course, it was maintenance, right? Because we have recurring maintenance, and then you have the enhancement sales. I would say enhancements that you can sell, or call it extras that you can sell to your existing base. I mean, that makes a private equity guy's or gal's eyes just light up like that. There's money to be made, right? There's margin there, and there's a return on investment. And so, especially if executed well. And so, I think, there's a couple of other specifics that make landscaping interesting. I lost my train of thought. I had one other one, but anyhow, I think, this kind of essential recurring revenue with this enhancements piece. But what now we're kind of seeing, and as I have kind of a inside look with, my dad and what he's doing, we're finding out that construction is, there. When we sold, construction was like, nah, we're not going to pay anything for it. Now construction has become a mix that equity groups are okay with. And we're even seeing, some incredible private equity backed companies in the design build space. And so, I think, it's now shifted to where can we just put our money that's as safe as possible, but can still get the returns that we need. So,
Yeah. I think that's where, it's a safe bet, if you will, in the landscape maintenance side. And we're not seeing, like, you have a turnover, right? Like industry standard, somewhere around 90% retention, maybe 85% on the low end, 95% on the high end. So like landscape maintenance typically retains their clients year over year. Whereas I think in some of the other home service spaces, they're profitable and they're paying super high multiples for HVAC companies and electric and plumbing, but it's not as much of a recurring model as the landscape maintenance side. And it's harder to scale that across regions. And you could say that about landscape maintenance too, but you can get in with a good big commercial property management company, for example, that is multi-region, and you just kind of follow them around and just, you do really good at one region, and they're like, hey, we have all these properties over here in this new geo. Like, do you guys want to go over there and work there? And we've been like, yeah. And then you go there and you do a good job there, and they like you and they hire you, and then boom, you do it again and again. So when you can team up with those bigger companies and do a good job for them and be their go-to landscaper, it just makes a huge difference. Now,
absolutely.
Yeah. I want to talk a little bit about the design build, because that is a newer model that we're seeing. Probably Frank Mariani and the Mariani Premier Group is the first to really do it at scale. And they're up there over half a billion now.
Yeah.
What do you think it is about design build and that space that has everybody so excited and paying maybe like similar multiples to Manion's, like 7, 8, 9x profit?
Yeah. It's interesting. The West Coast versus the East Coast, Midwest design build companies are very different in a lot of ways. And I'm not an expert by any means on either coast, because we didn't do much design builds work. We did a little bit, but especially in the high end space. So I can't speak too much to this. But look, I think what's interesting is you've got homeowners who want to spend money, usually call it high-end residential that are, high-ticket items, and then you can get the maintenance on it, right? And so there's a play there. I'll speak to San Diego's market. It's really interesting. From what I've seen, there's about 4 or 5 companies. They're all doing about 5 million, and they've all been about 5 million in revenue, and nobody's really owned the market. And then you have all these other like mom and pops or just like design only companies. And I think, there's a big opening there for companies like Mariani to acquire great design build firms and really continue to grow. And especially I shouldn't say all, but much of the investment is private equity investment is focused on this commercial landscape maintenance, right? Like that's the hot focus for landscape. But I see a huge opportunity. I'm kind of letting the cat out of the bag here. That design build is, it can be more cyclical, but you put together the right playbook, like you can crush it, and the margins are great, by the way. And so when you're getting $75 an hour on the maintenance side, and and you've got
on a good day,
and great margins on your construction projects, like it becomes pretty attractive. And again, you have to protect the downside, but with a well put together playbook where you're diversified across your design build and your maintenance, like it becomes a pretty attractive investment. And so I think we're going to see more opportunity and more investment come into the space on that side of things. And we're seeing like private equity, I think, filter through these industries, cherry picking kind of the best, right? And now coming downstream into landscape roofing, and then through landscape and roofing, they cherry pick kind of the best of, call it commercial maintenance, right? And now it's going to float downstream to design build with some more maintenance, right? And then eventually they'll be done with landscape, and it'll be on to the next. So, yeah.
There's kind of like that private equity pyramid, as some people say. I'm reading this book called Empire Builder by this guy, I think it's Brian Coffey or something, but it's a great book. Highly recommend it. And he explains private equity is like this like pyramid. Like at the bottom, you have like, low market, small cap private equity guys looking for that, 3 to maybe 10 or 12 million in EBITDA. And then you have the mid-market guys that are like, they're like 10 to like 50 million in EBITDA. And then the large cap, they're ideally over 100 million in EBITDA. Yep. And so many people are like, well, what's going to happen to landscaping? Because, once you get over 30 million, like there's no buyers. I'm like, yeah, there's no buyers today. But if you look at technology and other sectors,
to clarify, 30 million of EBITDA?
30 million of EBITDA.
Yeah. Okay.
Thank you. Yeah. Yep. 30 million of EBITDA. Like people are like, kind of, that's like the peak that we see. Yet there's a lot of companies in the top 10 of the top 100 landscape companies that are very much above 30 million. And I do think there's this next level of private equity that's going to be entering our space that have typically played in bigger markets like the technology industry, and they have really large funds. And I do think that at some point we're going to see those large caps start to buy some of the bigger companies versus taking them public. Because that's, you kind of get to this point where it's like, you got these 10 private equity companies, or you go IPO, and BrightView hasn't really showed this like awesome, exciting IPO experience for landscaping. We'll see if someone else goes after it. Hopefully they do, just for more data out there. But going down into that downstream of the smaller cap private equities, like there's so many of those guys. And there's literally there's I forget the numbers, but it's grown like 400% in terms of private equity funds compared to 10 years ago. So it's not like there's a lack of new private equity companies out there looking to buy.
Yeah. Go for it.
I think we're gonna see more construction companies and more, I don't know, street sweeping companies and others get entered into the fold as valuable assets in their funds.
Yeah, absolutely. And I've seen equity groups are now raising funds for vehicles that are just investing in less than 3 million of EBITDA businesses, right? Now it used to be minimum of like 3 million in EBITDA, otherwise we can't touch it. Now they're coming further downstream, and these aren't, call it add-on acquisition. These are platform investments in the 1 to 3 million EBITDA. So, even smaller than where they were, because they've got the capital. Their LPs are wanting to give them more money, and where do we put it all? There's so much competition for these deals that they have to keep coming downstream, and all of the value creation, the big upside is in these smaller, call it, well, it used to be the 3 million and 3 to 10 million where you could create a lot of value and then sell it. Now they're coming even further downstream, and I think that presents a challenge though, just because now you're playing in these smaller, unsophisticated businesses, and there's going to have to be a change, in my opinion, mindset around how private equity operates these companies. Because it used to be, well, if you have a 3 million EBITDA plus company, like usually there's some sophistication, not all the time. Sometimes there's very little, but you've got a decent amount of sophistication. You might have a bit of a team and some infrastructure that you can build off of. Less than that, I mean, now you're playing with companies that most don't really have a full built out executive team or technology or systems and process. So you're actually in more of a builds, really building the business while trying to deploy that capital as fast as possible and then exit it. So it's going to be interesting to see how this all plays out. And I think, again, private equity, it's great for the industry because it creates so much opportunity, whether you want to sell or you don't. You got an exit opportunity if you want to sell. And if you don't, you're going to be picking up work, because while they're trying to figure out how to operate these companies, piece them all together, like they're going to be losing work, and you as the operator are going to pick up, great contracts that they lose. So, I think it's great. It's exciting. I mean, there's never been a more opportunistic time in the landscape space, and so I'm pumped for everybody who's operating right now.
Yeah, no, I completely agree. It's an exciting time, and whatever your niche is, whatever your focus is, whether you want to sell, not want to sell, maintenance, construction, whatever you're doing, there's opportunity there. And there's also the most data that's ever been available to us in terms of the value of your business. Because I think 10 years ago, no one really understood enterprise value or how valuable a business was. But if you've found a way to grow a business to $20 million in revenue, you have a very valuable asset on your hands. But I just want to comment on the small company acquisition playbook, because I think someone that we've seen prove that out is Landscape Workshop and JT Price. And JT Price is a master integrator. And their entire focus was $1 to $3 million EBITDA businesses.
Yeah.
And they did a lot of deals, and they acquired and integrated those companies really, really efficiently. And they just had to exit, and it was nothing's public, obviously, but it sounds like it went really well. And I think that is a model we're going to see played out, like you said, because there's a ton of those businesses, like thousands and thousands versus maybe hundreds in the 3 million and above EBITDA, and B, our opportunity to make a larger EBITDA arbitrage transaction where you buy for maybe a 5x or 6x and then you sell for a 12x. That's starting to disappear from those $3 million EBITDA companies.
Absolutely.
Because 3 million is still, they're pulling out big multiples. Like some of these are going double digit. And I'm still seeing the small guys, like even the $1 million guys they're getting 7, they're getting 8, they're getting 9. Like, you hear these deals and you're like, what the? But they got capital to deploy, like you said.
Yeah, I think a lot of that too is, as an operator, getting that, getting that kind of crazy multiple is being a lot of luck. Being in the right cycle with the right private equity group that's about to recap. If you know where they're at and they're looking to recap, maybe that's a trade secret. Usually you can edge out another turn or two on the multiple, because they're gonna get their return, and they're gonna still make what they sell for, recapitalize that multiple wise is gonna be less than what they pay for you. And I've seen that a couple of times where they'll just pay an extra turn or two because they know they're flipping this thing pretty quickly, and it just adds. There's literally value without doing anything. So, and when I say without doing anything, I mean they got to go through due diligence and you got to spend money and so forth. So there's some work on that end, but
it's different though. I think that's such a key point you bring up is a cycle. And the cycle guys, like if private equity's they buy a platform company, and let's just say we're seeing cycles. They want to be 2 years and 3 years, but really they're like 5 to 7. So let's just say it's a 5-year cycle. They buy a $20 million revenue business, and they buy a bunch of others. Well, they get to the end of the cycle. They're $100 million in revenue. They're going to sell. Well, they get into a deal and they're going through the process of selling, and that takes, let's say, 60 days. Well, in that process, if they come across a business that fits the model, that's 58% maintenance or whatever their model is, they're already in negotiations to sell their entire company for maybe, let's say, 12 times. And then they find this company that's $1 million in profit, and they can buy it for 8 times. Well, they're going to make $4 million minus fees and everything else on that deal in a 60-day period. Yeah. And this has happened recently because a lot of companies are in that cycle, and people are like, it's like you can get a couple extra million for your business, and they're happy to pay it because it's just adding to the pot. And the new buyer is happy to have them add more because why not? I get a higher volume at the last minute than what I had planned to. So I do think those are situations, you said it, luck in a lot of ways. You're at the right place at the right time with the right business and the right network. I think network's incredibly important here. If no one knows about you, then you're never going to get that phone call. So I do think branding and getting out there and making the world and the industry know of your brand as a company and as a human, as an executive, I think is never more important than today.
Yeah. Couldn't agree more. I think you're really leading the charge on that, by the way.
Thanks. For better or worse, man.
For better or for worse. But I think it's look, I mean, we've seen it done in a lot of other industries. Why not the landscape space? And I think that's what you probably came to that conclusion and said, why not me?
Why not me?
Yeah.
I gotta shout out Jeff Harkness for that one. He came to me and was like, why not you? Why not you? So he's had a big impact on my new vision of where we're going to take K&D by 2035 and all that other fun stuff. And,
amazing.
Well, Christian, I want to get to the trade secret, even though we dropped some good ones on here. But it's a state, it's part of our show. And I think I love this part of it. So for you, what's a trade secret that you want to share with the audience? It's something that you can't learn in a book, something that you got to go through the hard work to learn.
Yeah. So we've talked about this, Justin. And I think the trade secret is really being the low cost provider. And that's not the low price provider, which is it's often mixed up as. It's the low cost provider. And what that means is your cost structure, right? Your cost of goods sold, we'll just take it. And really your labor is as lean as possible. Because when you're the low cost provider, your P&L has the least amount of cost next to all of your other competitors out there. That means you're going to have margin. So you can compete on price. If you need to come down, you're still going to have margin, or you should. And if you don't compete on price, you're going to have even more margin. You're going to have more profits to play with. And that's going to allow you to win. The low cost provider, in my opinion, wins every single time because they can be flexible. They can come down in price. They can stay, at the price they need to stay at. And they're just going to have profit dollars to play with. It's going to allow them to grow, invest in their people, technology, all the things that they need to do. And so for me, I've really been spending a lot of time thinking about being the low cost provider and what that means. And to me, that it's a win. You can't lose being the low cost provider. And again, I want to emphasize that it's your cost as an operator. Yeah. Your cost in your P&L, your overhead, your cost of goods sold, right? They're as low as possible so that you can be flexible if you need to come down on price or if you're going to stay on price. You're going to have margin that's going to allow you to win. That's it. And so hopefully that trade secret lands and it's not easy, by the way.
No.
It's not easy, but that's the thing, right? We talk about scale, BrightView, they can compete on price. Why? Because generally they have synergies, right? Mm-hmm. Their P&L can tighten up a bit and they can compete on price. And we often say, it's the little guys, right? Because they're profitable because they've got no overhead, right? And so they can again generally compete on price, or they're going to make or they're not going to compete on price and they're going to make a bunch of money, and it's because their P&L is the ratios, right, are favorable to them. Yeah. So I'll stop there, but yeah, I just love that. I love it.
That's a good one, man. My head's spinning right now because I'm just thinking the lean management principles and trying to get your company we had a big discussion last week about this. And at a company you go through, I think the most common barriers are 5 million, 10 million, 20 million. And you get to the point where you're fully leaned out and you're like, gosh, we can't take on another crew. We can't do anything more without hiring another manager because we're so lean. But I think you get to these points and you end up hiring too many people because you think, hey, we might as well build out for 30 million if we're at 20 million, or if we're at 5 million, we might as well build out for 10 million. But then it takes you 4 years to go from 5 million to 10 million. And that whole time you're just dragging that extra overhead and potentially extra field team members. Yeah. So you bring up such a important business fundamental. Manage your costs. And I will say, when you talk to the best entrepreneurs in the world measured by their enterprise value, Elon Musk, Jeff Bezos, Mark Zuckerberg, they obsess over cost. And Jeff Bezos is probably the one that's most well known for obsessing over cost and going low cost. And for him, his whole model, low price. Yeah. And he's been able, I just drove by a Rite Aid that's going out of business yesterday. Amazon, another, they're just taking people out.
Yes,
so
exactly.
I love this business fundamental, this trade secret. So well said. And for people out there, I think you can take that back and look at working in those metrics and getting your overhead, your cost of goods sold, your labor, just a lower and lower percentage of revenue. So Awesome, man. Well, hey, with that, I think that's a great show. We dropped a bunch of value and had a good conversation. So thanks for being on today.
Yeah, Justin, thanks for having me. I look forward to jamming with you again, man. It's always a great time, and just love chatting with you and excited for the future.
Yeah, awesome. Well, guys, thanks for stopping in and listening to this. If you want to give Christian Heaviland a follow on LinkedIn, he's pretty active on there, drops a lot of insight. So you can find him, just search Christian Heaviland and he'll come right up.
Yeah. Thanks, Justin.
Man. Thank you. Have a good day.
All right. We'll talk soon.
Thanks for tuning in to TradesTalk, where the next generation of disruptors comes to raise the bar. If you got value from today's episode, share it with someone in the trades who's ready to level up. For more tools, insights, and community, follow host Justin White and join the movement at jwhitegroup.com.